Copyright disclaimer. Under Section 107 of the Copyright Act 1976, allowance is made for fair use for purposes such as criticism, comment, news reporting, teaching, scholarship, education and research. Fair use is a use permitted by copyright statute that might otherwise be infringing. Welcomes to Chartered Accountant channel. Today taking about Chapter, Theoretical Framework. Unit 1, Meaning and Scope of Accounting. Video No. 2. Evolution of Accounting as a Social Science. In its oldest form, accounting aided the stewards to discharge their stewardship function. The wealthy men employed stewards to manage their property, the stewards in turn rendered an account periodically of their stewardship. This stewardship accounting was the root of financial accounting system. The presently followed system of double-entry bookkeeping has been developed only in the 15th century. However, historians found records of debit and credit dating back to the 12th century. Although double-entry system was followed, stewardship accounting served the purpose of businessmen and wealthy persons at that time. In most of the countries, stewardship accounting was prevalent till the emergence of large-scale enterprises in the form of public limited companies. In the second phase, the idea of financial accounting emerged with the concept of joint stock company and divorce of ownership from the management. To safeguard the interest of the shareholders and investors, disclosure of financial statements, mainly, profit and loss account and balance sheet, and other accounting information was molded by law. Financial statements give periodic performance report by way of profit and loss account and financial position at the end of the period by way of balance sheet. It got the legal status due to changing relationships between the owners, economic entity, and the managers. With the democratization of society, the relationships between the enterprise on the one hand, the investors, employees, managers, and governments on the other, have also undergone a sea change. Also, the prospective investors and other business contact groups want to know a lot about the business before entering into transactions. Thus, financial accounting emerged as an information system to identify, measure and communicate useful information for informed judgments and decisions by a broad group of users. In the third phase, accounting information was generated to aid management decision-making in particular. It contributed a lot to improve the quality of management decisions. This new dimension of accounting is called management accounting, and it is the development of 20th century only. It is pervasive enough to cover all spheres of management decisions. Lastly, social responsibility accounting is in the formative process, which aims at accounting for the social cost incurred by business as well as the social benefit created by it. It emerges from the growing social awareness about the undesirable byproducts of economic activities. While earning profit, an enterprise incurs numerous social costs like pollution, using the resources of society like materials, land, labor, etc. To compensate for this social cost, in today's world, an enterprise is expected to generate some social benefits also, like employment opportunities, recreation activities, more choice to customers at reasonable price, better quality products, etc. Therefore, it is demanded that the accounting system should produce a report measuring the social cost incurred and social benefits generated. Social science study man as a member of society. They concern about social processes and the results and consequences of social relationships. The usefulness of accounting to society as a whole is the fundamental criterion to treat it as a social science. Although individuals may benefit from the availability of accounting information, the accounting system generates information for social good. It serves social purposes, it contributes for social progress, also it is being adapted to keep pace with social progress. So, accounting is treated as a social science. Objectives of accounting. The objectives of accounting can be given as follows. Number 1, systematic recording of transactions. Basic objective of accounting is to systematically record the financial aspects of business transactions, i.e. bookkeeping. These recorded transactions are later on classified and summarized logically for the preparation of financial statements and for their analysis and interpretation. Number 2, ascertainment of results of above recorded transactions. Accountant prepares profit and loss account to know the results of business operations for a particular period of time. If revenue exceed expenses, then it is said that business is running profitably, but if expenses exceed revenue, then it can be said that business is running under loss. The profit and loss account helps the management and different stakeholders in taking rational decisions. For example, if business is not proved to be remunerative or profitable, the cause of such a state of affair can be investigated by the management for taking remedial steps. Number 3, ascertainment of the financial position of the business. Businessman is not only interested in knowing the results of the business in terms of profits or loss for a particular period, but is also anxious to know that what he owes, liability, to the outsiders and what he owns, assets, on a certain date. To know this, accountant prepares a financial position statement, popularly known as balance sheet. The balance sheet is a statement of assets and liabilities of the business at a particular point of time and helps in ascertaining the financial health of the business. Number 4, providing information to the users for rational decision-making. Accounting as a language of business communicates the financial results of an enterprise to various stakeholders by means of financial statements. Accounting aims to meet the information needs of the decision-makers and helps them in rational decision-making. Number 5, to know the solvency position. By preparing the balance sheet, management not only reveals what is owned and owed by the enterprise, but also it gives the information regarding concern's ability to meet its liabilities in the short run, liquidity position, and also in the long run, solvency position, as and when they fall due. An overview of objectives of accounting is depicted in the chart given below. Functions of accounting. The main functions of accounting are as follows. A. Measurement. Accounting measures past performance of the business entity and depicts its current financial position. B. Forecasting. Accounting helps in forecasting future performance and financial position of the enterprise using past data and analyzing trends. C. Decision-making. Accounting provides relevant information to the users of accounts to aid rational decision-making. D. Comparison and evaluation. Accounting assesses performance achieved in relation to targets and discloses information regarding accounting policies and contingent liabilities which play an important role in predicting, comparing, and evaluating the financial results. E. Control. Accounting also identifies weaknesses of the operational system and provides feedbacks regarding effectiveness of measures adopted to check such weaknesses. F. Government regulation and taxation. Accounting provides necessary information to the government to exercise control on the entity as well as in collection of tax revenues. Bookkeeping. Bookkeeping is an activity concerned with the recording of financial data relating to business operations in a significant and orderly manner. It covers procedural aspects of accounting work and embraces record-keeping function. Obviously, bookkeeping procedures are governed by the end product, the financial statements. The term financial statements means profit and loss account, balance sheet, and cash flow statements including schedules and notes forming part of accounts. Bookkeeping also requires suitable classification of transactions and events. This is also determined with reference to the requirement of financial statements. A bookkeeper may be responsible for keeping all the records of a business or only of a minor segment, such as position of the customer's accounts in a departmental store. Accounting is based on a careful and efficient bookkeeping system. The essential idea behind maintaining bookkeeping records is to show correct position regarding each head of income and expenditure. A business may purchase goods on credit as well as in cash. When the goods are bought on credit, a record must be kept of the person to whom money is owed. The proprietor of the business may like to know, from time to time, what amount is due on credit purchase and to whom. If proper record is not maintained, it is not possible to get details of the transactions in regard to the income and expenses. At the end of the accounting period, the proprietor wants to know how much profit has been earned or loss has been incurred during the course of the period. For this, lot of information is needed which can be gathered from a proper record of the transactions. Therefore, in bookkeeping, the proper maintenance of books of account is indispensable for any business. At this level, the major concern of the curriculum is with bookkeeping and preparation of financial statements. It seems important to mention at this point that bookkeeping and preparation of financial statements have legal implications also. Maintenance of books of accounts and the preparation of financial statements of a company are guided by the Companies Act, banks and insurance companies by special acts governing these institutions and soon. However, for sole proprietorship and partnership business, there is no specific legislation regarding maintenance of books of accounts and preparation of financial statements. Objectives of bookkeeping: No. 1. Complete recording of transactions. It is concerned with complete and permanent record of all transactions in a systematic and logical manner to show its financial effect on the business. No. 2. Ascertainment of financial effect on the business. It is concerned with the combined effect of all the transactions made during the accounting period upon the financial position of the business as a whole. Thank for watching. Follow videos and learn more.